Welcome to today's episode of our webinar series, Cutting Out the Middleman, the surge in FinTech applications to charter banks, industrial banks, and national trust companies. I'm Alan Kaplinsky, Senior Counsel and the founder and former chair of the Consumer Financial Services Group for 25 years at Ballard Spahr. This is a repurposing of the webinar that we recently conducted. In this Part 2 series, we explore the fundamental shifts we're seeing in the fintech, payments, lending, and crypto sectors, especially as these companies increasingly seek bank charters to internalize the benefits that come with being a regulated financial institution, rather than relying on traditional partnerships with banks. In Part 1, which covers the material from the first half of our live webinar program, we'll kick off with a market overview, discussing the strategic drivers behind the surge in charter applications, and we'll follow that by a comparative look at charter options and the infrastructure drivers that are shaping this landscape. And we will also begin our study of the use cases. And in Part 1, we'll talk about crypto native firms and why they're interested in getting charters, and in particular, national trust charters from the OCC. And in Part 2, next week, we'll be looking at other use cases involving lenders, in particular buy now, pay later, and earned wage access companies, and the use case for non-banks that are involved in the payments business. Some of the key points we'll address in this first episode include the primary factors driving fintechs and non-banks to seek their own charters, the importance of regulatory considerations, and which regulators oversee different charter types. We'll talk about the critical role of business plans and capital requirements in charter applications, and we'll provide some insights on how access to the Federal Reserve payment system and stablecoin regulations are influencing strategic decisions. I hope you enjoy this in-depth discussion. Now, let's jump into Part 1 of Cutting Out the Middleman. Over the past several years, especially more recently, during Trump 2.0, we've seen a significant shift in how fintech companies, payments firms, lenders, crypto native businesses approach regulation growth. Increasingly, these firms are not just partnering with banks, they're seeking to become banks or bank-like institutions, or as I put it in the title of our program, they want to cut out the middleman. And importantly, this trend is unfolding during what may be one of the most favorable political and regulatory environments in recent memory for charter applications, and indeed, in my entire period of practicing banking and consumer finance law. I don't think the political environment has ever been as favorable right now for what we're discussing today. The Trump administration and the federal banking agencies have, at least so far, taken a very supportive posture toward innovation and toward new entrants into the banking system. That doesn't mean, however, that the process is easy. It is not an easy process. It takes time, and it takes a lot of care, and there's a requirement to work with people who've got a lot of experience and expertise. What I am saying, however, is that the door may be more open right now than it's been in any time in the past. What's striking is that in just the past year, regulators have conditionally approved a broad section of applicants, from crypto-native firms like Circle Internet Group and Ripple Labs, to infrastructure providers like BitGo and Paxos, to major platforms like Stripe, and even a full-service de novo bank in Erebor, underscoring that this is not a niche trend, but a fundamental shift in who is entering the banking system. Let me briefly walk you through how we'll cover this topic today. We'll begin with a market overview, examining the forces driving this surge in charter applications. We'll then move into a comparative discussion of charter options, followed by a look at infrastructure drivers, including payment system access and stable coins. The core of today's program is going to focus on three use cases that are consumer finance oriented. First of all, crypto native firms. Second, lenders, including products like buy now, pay later, or earned wage access providers, who we typically don't consider to be lenders, at least those of us in the industry, although that is an issue that is in and of itself subject to debate. And then the third use case will be payments providers. We'll then turn to the practical pathway on how to obtain a charter. And finally, we'll discuss what happens after you become a bank. We will run through the chronology of events. Let me now introduce our panel. And I first want to introduce our very special guest, Lee Reiners, who is a lecturing fellow at the Duke Financial Economics Center and a widely recognized thought leader on financial regulation, not just on the topic of crypto that he'll be discussing today, but on really banking and financial regulation and AI. His broad research agenda focuses on how new financial technologies fit within existing financial regulatory frameworks. Previously, he worked at the Federal Reserve Bank of New York as an examiner of systemically important financial institutions. So, Lee, a very warm welcome to you.
Thank you, Alan.
Okay, now we'll go to the Ballard Spahr team, and we're going to start with Scott Coleman, who is a partner at our firm located in our Minneapolis office. For over 30 years, Scott has represented banks and bank holding companies in connection with mergers, stock purchase transactions, branch purchases and sales, capital raising, corporate restructuring, branching, non-bank acquisitions, changes in bank control, charter conversions, corporate governance. But for purposes of today's program, Scott has had an enormous amount of experience working with organizers seeking to form banks or bank holding companies to apply for deposit insurance and charter new depository institutions. Just in the recent past, Scott's been involved in the following three bank fintech transactions: the acquisition of Global Innovations Bank in Keister, Minnesota, by a processor specializing in processing payments for military and government contractors stationed abroad. Mid-Central Federal Savings Bank of Wadena, Minnesota, which was acquired by a fintech company called GECO. And finally, Centrust Bank, Northbrook, Illinois, acquired by a fintech lender, SmartBiz. Let me introduce Bo Pertig. Bo is a financial services attorney, also in our Minneapolis office, with over 20 years of experience in bank mergers and acquisitions, payment systems, and bank regulatory matters of all sorts. He has served as general counsel during the organizational and de novo phases of Dayforce National Trust Bank and he oversaw FinTech legal operations as Associate General Counsel of Dayforce. Adam Merrick is a consumer financial services attorney located in our Washington, D.C. office. He has over a decade of experience representing global financial institutions, both as in-house counsel and through his private practice. Adam advises clients on regulatory compliance issues related to a wide variety of consumer and small business products and services, including credit cards, digital wallets, loans, deposits, data sharing agreements, and deployment of emerging technologies, including AI, in a wide range of matters across the FinTech industry. And certainly, last but not least, our partner, Joseph Schuster, who is located in our Denver, Colorado office. And Joseph has had 2 stints with our firm, began his career as in-house counsel at Nordstrom's Credit Card Bank in Denver, came to our firm, left our firm after several years to join Goldman Sachs in Manhattan, and was very much involved in the diversification of Goldman into consumer finance, including most notably the Apple Card, the Apple credit card. Joseph has been back with our firm for about 2 years now and has a very eclectic practice, but he's going to be very focused today on talking about why is it that FinTech lenders are so interested in cutting out the middleman, the middleman here being the banks, as I'm using it colloquially. So I welcome to all of our...
Eclectic, that sounds good. Yeah, thank you.
Okay, well, it is eclectic in the sense that literally I don't think there's an area of law in the consumer finance area that Joseph is not experienced in and doesn't have expertise. At least I haven't located one yet. He's involved in payments, lending, crypto, artificial intelligence, and I could go on and on and on. But our listeners want to hear what all of our experts have to say about this very important subject. So the first topic is the market landscape and strategic drivers. And I'm going to go to you, Scott, and we're calling it segment 1. So it's a very simple question here. What's going on? What are the primary factors driving this recent surge in FinTech and non-bank charter applications?
Well, feasibility is the primary factor, as you mentioned in your opening. A business case has always existed for applications such as this, whether it be to avoid state licensing requirements imposed on lenders or money transmitters, whether it's to benefit from federal preemption to avoid compliance with 50 state usury laws, export rates, whether it's to access a Fed account and the financial rails, or simply to avoid entering into a bank partnership arrangement where you're sharing revenues with the financial institution. There's an advantage to having a bank or an ILC charter. That said, there's a belief that it's possible to obtain approval of these kind of transactions and these applications under the current administration. That's evidenced by the 25 applications for deposit insurance that are currently pending with the FDIC. And it's a belief that's been born out of the agency's statements. The OCC has said they're open to FinTech applications and applications by monoline businesses like mortgage originators and other specialty lenders. And as you mentioned, the receptivity of the administration to crypto and other innovations is also a factor. So the business case has always existed. The feasibility is a driving factor, and since, as you mentioned, these applications don't proceed necessarily quickly and are burdensome, time is of the essence for people who are serious to be thinking about this.
Who knows what's going to happen, Scott? In a year and a half from now, it could be new president, could be different party. There could be, if that happens, all the management of the banking agencies will change, and things could change very dramatically. So what we're talking about, I guess it's fair to say, it's a window that is closing every day. Is that a good way to put it?
I would agree that that is possible. The pendulum can swing the other direction, and the time to move, given the time it takes for an application like this, is literally now.
Yeah. So I take it from what you've described, the trend, I guess my question is this trend being driven by regulatory pressure, or is it really strategic business opportunity?
On the lending side, I think state law challenges, which you've written about and Joseph has written about and blogged about, like True Lender, the Madden case, and the DIDMCA opt-out are certainly a factor. The 50-state licensing regime for money transmission and lending is also a factor. I think a key factor is the instability of the bank partnership model. We saw during the previous administration bank partnership models under attack across the regulatory agencies, whether it be for BSA/AML reasons, whether it be for safety and soundness reasons. We could call these regulatory factors, but if you're a fintech or a specialty lender, there's strategic considerations too. You know, the ability to control your own destiny potentially without interruption of your partner is a key factor.
Okay. So are crypto firms and lenders and payments companies, each of those segments motivated by different factors?
I'd say yes and no to that, Alan. I mean, crypto firms may want access to financial rails. Lenders may want to avoid state usury laws and benefit from interest rate preemption and avoid licensing. Payment companies want a more favorable licensing environment, and those factors will also drive the choice of the charter that they seek. But all of those factors are, realistically to avoid having to partner with a bank and avoid regulatory burden. So
right.
It's key that regulatory burden is a part of all of this.
Yeah. So you've already said that the regulatory environment when we're really talking about the prudential banking regulators, the comptroller, the FDIC, the Federal Reserve Board to maybe a little lesser extent because of at least the belief that there is somewhat independent, maybe the only quasi-independent agency, at least with respect to monetary policy, maybe not with respect to banking policy. But how are the regulators reacting to the influx of applications? Are they able to move these along? What's happening?
Yeah, I would say they're reacting generally favorably and that the applications are being processed. I've spoken with staff at the OCC, and they've stated the agency's willingness to look at novel business plans from non-traditional applicants. They're willing to do so on a preliminary pre-filing basis. The FDIC is also open to pre-filing meetings to kind of vet the proposals and hopefully address concerns before an application is filed. The FDIC for a number of years has been looking for more charter and deposit insurance applications given industry consolidation. Now they're getting them. I think there is a risk of a little bit of challenge because the agencies have seen a large number of their senior staff migrate out and into retirement or into the industry itself. And as you mentioned, the Reserve Board can remain a challenge. There is a little bit more independence there. They're a little more deliberate in their proposal. And when applicants have a holding company structure and are applying to the Fed, they're going to get a lot of questions about agreements among their investors and shareholders, other activities, control, and the like. And that can slow it down. There's positive energy with the regulatory bodies, but none of this means that an application will move quickly or that the business plan, capital proposal, and character and expertise of management won't be carefully scrutinized. But the applications are definitely moving through the system.
Yeah. Now, just to clarify for our listeners, you mentioned if you're forming a bank holding company, you need to get regulatory approval to form that bank holding company. The only other situation I'm aware of is even if you're not forming a bank holding company, and if you're a state chartered bank, you could elect to become a member of the Federal Reserve System. I don't frankly know why anybody would do that anymore. It just doesn't make a lot of sense to me, because if you're a national bank, you automatically become a member of the Federal Reserve System. Am I right? You don't need separate Federal Reserve Board approval for that, just the comptroller.
That is correct. We do have some state bank clients that have elected Fed membership, in part maybe for convenience, especially here in Minnesota where the Federal Reserve Bank of Minneapolis exists. They have a common regulator of the bank and holding company that's local. And so sometimes Fed membership is attractive that way rather than, dealing with the FDIC, which is a little more removed. But you are correct. State banks can either be member banks of the Federal Reserve System or non-members regulated by the FDIC, the OCC, which for federal preemption is clearly the gold standard. All OCC national banks are Fed members.
Okay. And a final question for you, Scott, before we move to the next segment is this the demise of the bank fintech partnership? Or do you think that not every fintech that's partnered with a bank is going to want to become a federally regulated bank and all that entails, and there still will be bank fintech partnerships?
Yeah, I think there will absolutely still be bank fintech partnerships. It doesn't mean that segment of the business is going to go away. It could mean that the proposals that remain will carry more risk, as they may involve partners with riskier business plans that can't get regulatory approval, or less capital and don't have the ability to go through the application process to get approval. But it's also the case that applicants need to be careful what they wish for, right? Having a charter is not the be-all, end-all. The burden of examination, potential limits on growth may cause some to conclude that owning a charter is not the best alternative. It's not a one-size-fits-all solution, and the evaluation of the feasibility and impacts of seeking a charter and the type of charter need to be considered carefully.
Yeah, and I guess you can't forget about the capital requirements. There are upfront requirements. You got to raise. It used to be years ago, as I recall, you needed, if you had $5 million of capital, you could start a bank. Now they really, the regulators are much more focused on your business plan and with the growth expectations that you have, and they look at very carefully at the various capital ratios, and it may be well more than $5 million. In fact, I'd say it usually is. Would you agree?
Yeah, I would say most of the deposit insurance applications we've seen recently have been somewhere between 40 and 100 million. It is driven by business plan. We've seen applications approved in the last couple of years with closer to 15 million of total equity. But then those applications are proposing a slower growth. I've actually sat down with potential clients who said they wanted to charter a bank and said, look, with your growth projections, they're just, too great for the regulator to be able to accept, and you ought to pursue partnership instead. And I think those evaluations, even in a favorable environment, still need to be considered.
Yeah.
Could I add to the question on the bank demise? I agree with what Scott's saying, that it will always be there. And the piece he's saying on the entities that are growing at such a rapid rate, that's a really good point. There's also the other piece of it where we saw a lot of bank partnership, or where we do see a lot of bank partnership where creditors used to have their own banks. In the retail credit card space, the co-brand space in particular, that is one where you saw a lot of retailers have their own banks for a period of time, that they were doing state-by-state credit lending, which I know, Alan, you did a lot early in your career, and they all acquired banks. They've now gone back to that partnership model. Those programs will continue to exist. I think that we'll continue to see those grow, even in a world where we see more traditional fintechs applying for and obtaining their own bank charters.
Yeah. Let me just add one other thing, and then we're going to move to you, Bo. that at least in the past, and I don't know if you've seen this recently, I mean, I chartered a bank many years ago that was a consumer finance company. This is well before the invention of the internet, although it was after dinosaurs. So, it's not that long ago. But we represented a consumer finance company that wanted to become a national bank for interest rate exportation purposes. They didn't have the cash available to charter a bank, but the comptroller allowed the capital to be infused into the bank in kind. And they did a purchase and assumption transaction where basically all the assets and substantially all the liabilities of the finance company were converted over to the national bank. They had to have somebody come in and appraise the assets so that the comptroller could put a value on it. But I don't think it necessarily has to be cash. Anyway, that's the last thought on that. All right, Bo, we've got that foundation laid so well by Scott. And now what I'd like you to do, if you could, is walk us through what these charter options are. What are the key differences among national banks, state chartered banks, industrial banks, and of course, national trust companies, because that seems to be the charter of choice for a lot of crypto native companies.
Yeah, thanks, Alan. So there are literally treatises written on these types of differences and a number of factors to consider. So when you enter this process, I'd encourage you to streamline your thoughts. And the way I think about it are the primary factors that you'd want to consider when getting started are who will be your regulator, or how are they regulated? Scott touched on that a bit. I'll go into a bit more detail. What is the function or the goal you want to accomplish? Because the charter varies. And what's your ownership structure look like? Because your activities or your ownership burden can be restricted depending on the type of charter you choose. So again, I would agree with Scott. He said the gold standard is the OCC regulated national bank. These are basically full service banks, JP Morgan, Citi, but also they're smaller. But they're the kind of banks you would typically think of when you're thinking of big banks, though the asset size can vary. Those will have full service. They can take deposits. They can do lending. They're regulated by the OCC, which again is traditionally viewed as one of the tougher regulators. They all have their pros and cons. Functionality is basically wide open. The ownership, though, will be a bank holding company regulated by the Federal Reserve with severe activity restrictions. So an important point to consider. I'll kind of work my way across. Next, I would say as far as functionality, you would have a state chartered bank. That means instead of applying to the OCC, a federal regulator, you get to pick which state you would charter your bank in. And all states will charter a bank. They generally have full service with the lending, the deposit taking. You also have to apply to the FDIC for the ability to take those deposits. And again, if you have a holding company, it's got to be a bank holding company registered with the Federal Reserve. So then I would classify the last two, ILC and the National Trust Bank, as providing a little more flexibility as to ownership. They're both, as long as the National Trust Bank doesn't accept deposits, which they wouldn't, they're not going to be regulated by a bank holding company. So there's more opportunity and flexibility to establish those under different types of companies. However, your activities now get a little more restricted. An ILC can, if it gets FDIC insurance, can accept deposits, so it has that available. It can do, lending and other types of activities. It's going to be primarily regulated by the state regulator in which it establishes itself. And then moving to the National Trust Bank, you are regulated by the OCC. However, again, if you don't accept deposits, your holding company does not have to be a bank holding company subject to regulation by the Fed and activity restrictions. And kind of the trade-off is you're supposed to be limited to basically custodial or fiduciary trust type activities and some related activities. So more activity restrictions, you're not going to accept deposits, but more flexibility in ownership.
So, question, I probably should have asked Scott this question, but you mentioned the bank, in order to be a bank holding company, there are restrictions on the activities of the holding company and non-bank affiliates of the holding company. Generally, there has to be activities that are related to banking in some way. You could have a consumer finance subsidiary, for example, or a company that was involved in lease financing, commercial lending, and all kinds of things. But a bank holding company couldn't be, for example, a brokerage firm. Am I right? That would not, although you could have financial institution holding company under those circumstances.
Yeah, that's right, Alan. But even your example highlights the sophistication there, right? You're restricted in certain activities that are related to banking. You can make the financial holding company election, which increases the ability to do a few more things, but it's an analysis you have to go through. Also, holding companies have capital and reporting requirements. Their financials are very public. And so it's just a road that many non-traditional banking or financial companies want to enter. Perhaps they do, but you need to be very aware of restrictions, reporting, those types of things.
Right. And there could be some entities that wouldn't even be eligible for the financial institution holding company. And in those situations, you can't have a holding company. You'd have to actually figure out a separate way for individuals to charter a bank and essentially start all over. But that doesn't, right. In most cases, you do need a holding company because you're going to want that the business that you're currently engaged in to be affiliated with the banking institution. Am I right?
Right. And you lose your corporate structure if you're having a third party, have ownership. Right. So agree to keep it in the corporate structure. You'll right. want to stick within the bank holding company restrictions or financial.
So we mentioned a little bit earlier interest rate exportation, Bo, and federal preemption. That can influence the charter choice. And I guess that's sort of a no-brainer. If that's what you're looking for, it's a national bank, right?
Yeah, although I would say with your interest rate exportation, it doesn't have to be a national bank. The state banks can typically export their interest rates to where they're chartered. Same for ILCs. However, the federal preemption, in my view, can be very beneficial. And the preemption is broader than just interest rate exportation. Where I think that can come in handy is if you're engaging in true money movement. I know we'll touch on it later, but perhaps earned wage access activities where you have state licensing that touches on the function of either a national bank or a trust company or a national trust bank. The benefit of preemption can be very real. It's not entirely settled. The states may make their case that something or another is not preempted, but generally speaking, there can be tremendous benefits to getting an OCC type charter and being able to take advantage of federal preemption.
Yeah, I mean, you're referring to, a few states that have opted out or purported to opt out of federal preemption for state charter banks. There's a lot of litigation pending right now to resolve that issue of whether or not, if a state does opt out, it doesn't only affect the banks that are actually chartered in that state, or could it affect out-of-state banks that lend into that state? And there's litigation going on right now in the 10th Circuit Court of Appeals dealing with that issue. The other thing I want to say, because a lot of people that I've met with and have conversations with about a national bank charter. It does not override all state laws. That is a myth that I've had to bust on many occasions. If it's an interest rate related usury type of law, yes, those kinds of laws are preempted. But if it doesn't deal with interest and usury, then that is very much an open question. And I know, Joseph, when we get to the lending segment, we'll dig down a little bit deeper on that subject because it's an unresolved issue by the Supreme Court. If the state law is going to have a significant impact on the national bank, then it's preempted. But what that means, significant impact, is very much an open issue right now with litigation in the Ninth Circuit, Second Circuit, First Circuit, and we'll delve into that a bit later. So you mentioned industrial banks. There were a few states that do permit the charter, but it seems, Bo, like most of them are chartered in Utah and Nevada, right? I mean, that's where the action seems to be.
Yeah, agreed. And remember, we talked about the exportation of the state interest rates. Yeah. Those states are among the handful that you referenced. I believe there's 7 that permit these industrial loan companies or industrial bank charters. Interestingly, Minnesota, where I'm located, is another one. However, you don't see a number of banks rushing to form an ILC in Minnesota. And the reason is we have enhanced consumer protection laws, and also our interest rates are not as favorable. And so I would say that's one of the primary driving factors is you have favorable interest rate or usury laws in those states. And then beyond that, Utah has taken a long interest in facilitating these types of charters. They've established some of the infrastructure, well-bodied law. It's similar to why do you incorporate in Delaware oftentimes? You have the infrastructure there, you know what you're going to get. Other people have done it, there's precedent. And so it will continue to happen. I will say, we talked a little bit. I was in private practice for 14 years, then went in-house for 7, and now I'm back in private practice. And for much of my early career, from 04 to 17, you didn't see these industrial banks popping up because you couldn't get the FDIC deposit insurance. There was essentially a moratorium on that. There was concern that commercial business was being blended too much with banking. And so in 2020, there was sort of a brief window. Again, we talk about windows. There was one there to get the FDIC insurance. Some entities took advantage of that. The window then closed for a period of time, but it seems to be back open. So yeah, if you're looking for an industrial bank, Utah or Nevada is probably the place to start looking. And now is a favorable time.
Yeah. And they're usually, you have to acquire, at least it used to be, you had to do a change of control application, acquire an existing one, not charter one, but maybe that's changed. I'm not sure.
Yeah, I'm not sure on that, but I don't think it's changed. I think there's still a change in control in existence.
Yeah. And there are a limited number of charters that are there. So, now one of the reasons why, all industrial banks have a state charter, and you wonder, well, why is it that these fintech companies didn't partner with national banks? Well, until Trump 2.0, it was not something that the comptroller was going to look at very favorably. In fact, the comptroller's got a whole entire history that goes back to payday lending, partnerships with payday lenders, tax refund anticipation lenders. They didn't like that at all. But that, fortunately, the attitude has changed markedly. Final question for you, Bo, is where do the national trust companies fit in for the firms that don't need to have full banking powers?
Yeah, and keep in mind that the national trust banks are near and dear to my heart. I was general counsel at Dayforce National Trust Bank through the formation phase. we started that application under the Trump administration in 2019. The formation phase was under the Biden administration, and now it's back operating under the Trump administration. So, as Scott said, the pendulum can swing. I will say I didn't notice huge differences. The regulators still generally do their jobs, although the point of emphasis or the sobriety of the ask may change. But I do think there is a spot for the national trust banks. In my case, the good use case there, think about function when you're planning this out, was money movement. So Dayforce is a payroll company. It moved money each year. The trust bank was able to facilitate that and get some benefits of preemption. So that was a good use case. More recently, under the Genius Act, it seems that national trust banks will be able to issue stable coins, another good use case. And then think custody or fiduciary. Is there a way to hold assets or a use case for that? I think there is. I think there's creative solutions. And so, again, the National Trust Bank can be a useful charter. You're not going to have to register as a bank holding company if you're the ownership company. And there is some flexibility there, and you're going to have some benefits of preemption. So I think a good option that can still fit, depending, again, on the function and needs. Importantly, though, you will not be able to accept deposits. If you accept deposits, you're going to get kicked into the needing a bank holding company. So that's the drawback.
Right. Got it. Okay. Well, thank you, Bo. I'm going to turn now to Adam Eric. And this should be right up your alley, Adam, because you've spent a lot of time doing work for payments companies and non-banks and helping banks that have payments issues. So, Adam, my first question for you is, how important is access to the Federal Reserve payment system in making a chartered decision?
So I think, thanks, Alan. Glad to be on this presentation with all of my distinguished colleagues here. So I think we should start with a little bit of context, right? That most fintechs have historically operated through sponsor banks. And you have this layered model between the fintech, the sponsor bank, which then connects to the Federal Reserve payment system. And that creates dependency risks and costs and compliance friction as the fintech is relying on that sponsor bank for a whole host of things. And so charters help remove that layer as a whole. And so they expand capabilities, but they also remove that layer. And so I think, as Bo was alluding to, there's certain business models, use cases where this is really valuable. And so when your business model really depends on settlement control and instant payments and managing the dependency on a sponsor bank, that's where Federal Reserve payment system access, direct access, can really be valuable. And so if you think about all the intermediaries in the fintech's ecosystem, that each of those is both a cost center and a risk vector to be managing, the more critical that those payments are to the firm's business model, the more that they're going to want direct access without the burden of a middleman. So, the charter discussion is not a panacea, right? Just because you have a charter does not mean that you get a master account with the Federal Reserve. Back in 2022, they created some guidelines with tiering for insured depositories being tier 1 institutions with easiest access, down to tier 3 for novel banks and uninsured banks. And that is not a guarantee of access. So the charter type is material to figuring out how easy it'll be to have access.
Yeah, so our firms, they're seeking independence from sponsor banks. Is that because it's another middleman, and if you've got a sponsor bank, they're eating into your profits, I assume, and if you can eliminate them and have a master account at the Federal Reserve, which you should be able to if you're a banking institution and you've been chartered with one of the charters that Bo mentioned, is that really it, or is it control? Having, if you've got a sponsor bank, there's more, you don't have as much control. Or is it both of these things, independence and control? They're sort of connected, I guess.
Yeah, I think they're connected. And the importance of each sort of depends on the life cycle of the company and the stage of their growth and the products they're offering. I think independence became really clear with the collapse of Synapse, where these middleware providers, managing ledgering for banks and for Fintechs in between the two really became a weakness and a challenge. And so companies realized, well, hey, we need to oversee and manage a lot more of what those middleware type companies are doing. We've also seen some consent orders against sponsor banks, and that's made concentration of sponsor bank partnerships a real issue, an issue that has to be managed by boards, and it's become a board level risk. So having redundancy in a fintech bank sponsor relationship, having multiple sponsor banks is sort of essential nowadays, but at the same time is also expensive and creates redundancy that isn't ideal. So you have some competing concerns there with the need for independence. I think there's also a control piece here, right? That companies want to be able to be in control of their risk appetite, but at the same time, they don't want to be beholden to the bank's point of view and responding to the bank's exam cycle and so forth. So there's a shifting that's necessary of control between, for a fintech, from the fintech's point of view, are you subject to your sponsor bank's whims and their pressure? But if you switch to a bank, now you're going to be subject to federal bank examiners, state bank examiners, pressures and questions about that come through exams.
How about stable coins and digital asset developments influencing strategy?
Yeah, I'll let Lee speak to this in more depth in his discussion of native firms. But I will say that as you look at these stablecoin models, what their business models starts to look a heck of a lot like banking. And so when you have payments and stablecoins and banking charters coming together for a certain group of firms where those things are all critical, that's where you're seeing payments or banks and stablecoin companies trying to find this synergies between the charter.
Okay, well, you mentioned Lee, so I'm going to go to Lee right now. And Lee, we'll start out with a softball. It will be for you, although maybe not for a lot of other people. What types of crypto firms are actively pursuing charters? What's that all about, Lee?
Well, the short answer is all types of crypto firms. So notably stablecoin issuers or want to be stablecoin issuers, but it's broader than that too. It includes crypto exchanges. So Coinbase, for instance, has applied and received a national trust bank charter. So, this really kicked off, Alan, with the passage of the Genius Act, which I think, has been referenced already. President Trump signed this into law last summer. I think, as most folks are aware, it created a federal regulatory framework for permitted payment stablecoins here in the U.S. So these are dollar-denominated, fiat-backed stablecoins. And it became pretty clear almost, within a week, frankly, of it being signed into law, that of the multiple pathways, and I know we'll get into this, that stablecoin issuer could pursue to be compliant under Genius, that the preferred route was the OCC National Trust Charter route. Now, there is some precedent here. So notably Anchorage, which is a sort of well-known crypto firm, they did receive an OCC National Trust Bank charter in the waning days. I think it was like the last day or two of the first Trump administration. And, originally they said, well, look, this allows us to be a qualified custodian under SEC rules that apply to registered investment advisors. And if you're above, I think, $150 million is a RIA, you have to use a qualified custodian for handling customer assets. They've since expanded, as we'll probably get into, to essentially be a white label stablecoin issuers. So notably now, Tether's new U.S. affiliate, USAT, their Genius, what they claim to be a Genius compliant stablecoin, is actually issued by Anchorage. And to Donna's question earlier, I think, look, there's a lot of ink spilled about how the Biden administration was sort of hostile to crypto and Operation Choke Point 2.0, but it's notable that they did not rescind that charter for Anchorage, although they did enter a consent order around AML, BSA concerns, which they've since exited. So in terms of context, when the OCC issued its proposed national trust bank rule back in January, which clarified the OCC's view that national trust banks were allowed to engage in sort of non-fiduciary activities in addition to fiduciary activities, that sort of 4-page rule noted that there were roughly 60 national trust banks at the time, majority of which did not have deposit insurance, but some did. So thus far, we've seen the OCC issue conditional charters, national trust charters for at least 9 firms. There's 13 or so more applicants. And actually, you can see on the OCC's website, they have a specific section just for digital asset applicants. And it really covers the gamut. So the first sort of wave of conditional approvals in December, you had Ripple, BitGo, Fidelity, Paxos, Circle. But as I mentioned, Coinbase has applied and received, as it did Crypto.com. The most recent applicant from a few weeks ago is Kraken, crypto exchange Kraken's parent company, Payward, has applied. In terms of sort of what they want to do, well, again, it runs the gamut. It's non-fiduciary custody, it's brokerage, it's exchange, it's staking, which is a sort of specific aspect of crypto sort of consensus, and then settlement services. 4 of those 9, the OCC's order sort of granting the conditional approval specifically said that they would issue stablecoins. And the final note, too, is sort of hanging over all of this, and I think we'll get into this, too, is World Liberty Financial, which is the Trump-affiliated crypto firm, behind the USD1 stablecoin, some other products. They have also applied for a national trust bank charter, which is, as you might imagine, very, very controversial and is sort of playing a role right now in ongoing Senate negotiations over a crypto market structure bill.
Yeah. So, Lee, why is it that the trust company charters are particularly well suited for crypto businesses? Is it because they prefer, if they could, to have a full-blown bank charter, but there's too many restrictions on what they could do?
Yeah, I think, well, it comes back to a lot of the reasons that we've already talked about, right? So you don't want to be subject to the Bank Holding Company Act and restrictions on, activities and things like that, but really it all comes back to the Genius Act, right? And so, for those who aren't familiar, under Genius, there's essentially 3 pathways to become a permitted payment stablecoin issuer in the U.S. The first is you're a subsidiary of an insured depository institution. That's not particularly attractive for these crypto firms, right? Because then that comes with Federal Reserve, consolidated supervision, as we've already noted. Another way is you could be a state-qualified payment stablecoin issuer. So these are entities that are legally established under state law, but they're non-depository. So some states like Wyoming have created, special purpose depository institutions. The key thing there is that that's capped at, once you sort of go beyond 10 billion in stablecoins outstanding, then you have to sort of move up to sort of the third pathway, which is a federal qualified payment stablecoin issuer. All of these entities are, chartered, supervised by the OCC. So you could be a non-bank entity, you could be a federal branch of a non-US bank, or as we've said, the sort of preferred way is you could be an uninsured national bank. Now, note I say the law of Genius says uninsured national bank. It does not say national trust bank, which is, again, a source of controversy. And so, again, for a lot of reasons, it just makes sense if you're a large stablecoin issuer, right, or want to be a large stablecoin issuer. If you're already above 10 billion, you're going to be federal, regulated anyway. Most of these stablecoin issuers have, dreams of being above 10 billion in addition. So you might as well start, right, with the OCC. And by the way, it's quite easy to get too. So another reason why it's so attractive is because, as has been suggested, the OCC is certainly open for business. So, it gives you federal preemption. It also allows you to avoid a number of other requirements, as we've said, right? You're not a bank under the BHC Act. You don't have to comply with the Community Reinvestment Act. You're not subject to various prudential standards, including, enhanced prudential standards under Dodd-Frank. Volcker Rule doesn't apply. things like that. And also you can manage your own reserves too. So, I mean, a lot of this is about, as the title of the webinar says, is cutting out the middleman, right? So if you're a national trust bank, you're a stablecoin issuer, you can manage your own reserves. And it also makes it more likely for you to get a Fed master account. It doesn't guarantee that you'll get a master account, but you are eligible. And, I fully suspect, and we have seen, Kraken, I already mentioned Kraken, they have received a master account. Now, they don't have a national trust bank yet, but the Federal Reserve is also considering sort of a new type of master account. They're calling it a payments account. Governor Waller sort of previewed this a number of months ago in terms of a skinny master account. And, really, when I look at that sort of the contours of that limited payments account, it's clearly geared towards stablecoin issuers. So it increases the odds if you're a stablecoin issuer that you'll get access to, Fed payment systems.
Mm-hmm. Okay. So these charters, I'd like you to explain, how do they support custody, payments, and stablecoin issuance? I mean, you've already largely, I think, answered the question, but is there anything more you'd want to add to that?
Well, I mean, just a little context. So historically, trust companies were limited to fiduciary activities, right? And of course, there's a raging debate. We'll get into some of the regulatory challenges or potential hurdles going forward, because I do think we'll see litigation there. But the OCC earlier this year, did finalize a proposed rule that said, as I suggested earlier, that these trust banks can engage in non-fiduciary activities as well. And the critique of that is, well, look, now you're allowing limited purpose trust banks to enter the sort of the banking system, and they're focused substantially on non-fiduciary activities. And I think, as Adam said, that certainly seems to be the case with some of these crypto firms. One of the challenges in assessing all this is that the public portion of the applications contains very little information. There's very little detail. So when we see all these applications coming in, it's not entirely clear like why they want them, what they plan on doing. And in fact, BPI, the Bank Policy Institute, which represents the largest banks, they have filed a FOIA request with the OCC to try to get a little more transparency into these applications. And so we really don't actually find out, much about what they plan to do with these national trust charters until the OCC gives them the conditional approval. And in those approval orders, the OCC is actually quite explicit about, what they plan to do and what they're authorized to do. But as I mentioned, it's custody, it's brokerage, it's exchange, it's payments, it's staking. These are all things that clearly do not fall under sort of any traditional concept of what it means to be a fiduciary.
Right. What are the biggest regulatory hurdles, Lee?
Well, I mean, I think litigation, right, is the big one. Look, BPI, and this is sort of one of those issues that has created strange bedfellows, because you have progressives in Congress, led by Senator Warren, align with the banking trades, including the big banks and BPI and the community banks and ICBA and everyone in between, as well as consumer groups, right, like Americans for Financial Reform and the National Community Reinvestment Coalition, and others have all sort of weighed in on this issue and submitted letters opposing granting national trust bank charters to these crypto firms. And some of these letters, there was not so veiled language about saying like, look, we're going to sue, or we're thinking about suing. I know that The Guardian published an article a few months ago saying that BPI was considering a lawsuit. I think look, there's a lot of balls in the air right now. Of course, the Senate Banking Committee just last week voted on the Clarity Act, which would create a comprehensive sort of federal framework for crypto in the U.S. Now it's going to the full Senate. The banks are engaged in a sort of knockdown, drag them out fight with the crypto industry around what they call the payment of rewards loophole, or payment of interest loophole. Because under the Genius Act, stablecoin issuers were prohibited from paying the holders of the stablecoins any interest or yield, but it didn't prevent third parties like crypto exchanges from paying their customers for holding stablecoin rewards. And so the banks view this as a threat to their business and could lead to sort of massive deposit flight. And so they're trying to close that right now in the final Senate bill. And so I think for that reason, they're probably going to be hesitant to sue the OCC about these for fear of sort of upsetting the Trump administration and losing any leverage they have in ongoing negotiations there. But I suspect we will see a lawsuit at some point, and our good friend, our mutual friend, Alan, we were mentioning before we started, Art Wilmarth just came out with a very detailed paper today. Hopefully you can circulate afterwards that very lays out in a very comprehensive way that says, look, under the National Banking Act, the OCC does not have the legal authority to issue these national trust charters to these crypto firms. So that's one issue. There's, I think there's other issues. One is what happens when one of these things fails, right? So, the OCC has not had to, resolve a failed national trust bank, my understanding, since pre-FDIC. And, there's another issue around, well, is it compatible with the Genius Act, which says, crypto for, stablecoin issuers that fail would go through bankruptcy. And so how would this actually play out if one of these stablecoin firms were to fail? I think, another regulatory hurdle is, will they get access to not just the Fed payment system via master account, but will they eventually get access to the Fed discount window, which they're not currently eligible for too? But I think when push comes to shove, as we've seen with, Circle and Silicon Valley Bank, that if a large stablecoin issuer does get into trouble, there will be, a bailout or the extension of, the Fed's emergency liquidity. So I think, and then the final point too is World Liberty Financial. This is an absolute mess of a situation. The comptroller of the currency is between a rock and a hard place, because the reality is that if he approves this charter, and there's been a lot of ink spilled on all the problems at World Liberty Financial, the Wall Street Journal, broke the story that the UAE via a sovereign wealth fund bought a 49% stake in World Liberty Financial just a couple of days before Trump was inaugurated for the second time. So now you have foreign ownership in a potential bank. That raises a number of concerns. And so if the comptroller approves the World Liberty Charter application, there's going to be massive backlash. Right now in the Senate, this is going to be the next big fight over this market structure bill, which is conflicts of interest. This is, around, the president and crypto. This is yet another one. And so I think if the comptroller allows this charter to proceed, there's going to be blowback, and it'll potentially slow momentum for this market structure bill in the Senate. But on the other hand, if he doesn't approve it, Trump could fire him. So he's really, backed himself, because there's no, there's no removal protections for the comptroller of the currency. So he's really sort of backed himself into a corner, in my opinion, at least, with these, liberally granting these national trust charters. So we'll see how it plays out. But, it's certainly something to keep an eye on.
Thank you for joining us for part one of our special series, Cutting Out the Middleman, the surge in FinTech applications to charter banks, industrial banks, and national trust companies. I hope you found today's discussion helpful as we explored the market drivers, charter options, and regulatory considerations shaping this important trend in the financial services industry, and in particular, the use case for crypto native firms and why they seem to be quite interested in national trust charters. Be sure to tune in next Thursday, July 2nd, for part two of our series. We'll take a deeper dive into the charter application process, the challenges and surprises fintechs face after becoming banks, and we'll be offering practical advice to our panel of experts for navigating this complex transformation. We'll also be focusing on two additional use cases. The one for lenders, why they're interested in converting to or becoming a national bank, and in particular, buy now, pay later companies and earned wage access companies. And the main reason is to cut out the middleman, but more importantly, to have a stronger basis, a more secure basis for being able to export their interest rate allowed by the state where they're located under the Supreme Court opinion in Marquette National Bank versus First of Omaha Service Corporation. On behalf of our entire team and all of today's panelists, thank you again for listening. We look forward to having you join us again next week, July 2nd, for part 2 of our repurposed webinar. To make sure you don't miss any of our future episodes, please subscribe to our show on your favorite podcast platform, Apple Podcasts, YouTube, Spotify, or wherever you listen. And don't forget to check out our blog, consumerfinancemonitor.com, for daily insights about the consumer finance industry. And if you have any questions or suggestions for the show, please email us at podcast, that's singular, at ballardspar.com. Stay tuned each Thursday for a new episode of our show. Thank you for listening and have a good day.